Hi, welcome to this live webinar from the Living and Working Abroad show. Thanks a lot for joining us this week, and I hope you find it interesting and of value. We're on Twitter stream as well, so you can look at us there at that space to find out more about what we're talking about today on the Living and Working Abroad show. ProAct cover services for expats living and working abroad, relocating overseas, and investing offshore. Whether that's in property, in business, or financial investments, there's ways to save tax and save money so you're not paying more than you want to. But when you're an expat living and working abroad, the considerations you have to think about are what is the political, economic stability of the place where you work, what are the tax implications, and how do you maintain your tax records when you're working cross-border and on distance? What are the complications with having bank accounts and settling those matters when people die? And all those issues have added levels of complication and requirements, not just because you're dealing with different legal systems and different countries, but also with international standards and for trusts and taxes, common reporting standards, exchange of information, which has been extended to transaction records being maintained, as well as beneficiaries of businesses and trusts and properties. As people that are trying to Airbnb overseas property rentals are finding out this year. So there's a world of services that ProAct can offer an expat living and working abroad. Contact us for more information at our website at proactpartnership.com. But having said all that, and you can join in with the conversation on the Twitter space or live on our YouTube channel. We will get back to you. We at the Living and Working Abroad show, we cover specific issues, so hopefully you find this interesting value. If you've got a comment to make during the presentation, we'll answer that live and see where we can get to answer your questions. The first issue that we're looking at this week is a world of change. As you can see, I sometimes wear glasses, but in this particular presentation, I'm trying to not wear glasses, not for vanity reasons, but just for lighting reasons. And so I couldn't pick up my headline. So the first topic we're going to discuss today is a world of change. It's a global balance, and we've talked recently how China's situation has been changing around the world, and what's the impact of that on the world around us. We've got the Country Garden and Evergrande, mega Chinese property companies with lots of debt from around the world, invested in property which they've not been able to sell. They've got ghost cities in China, capital sitting there with a deflationary environment, decreasing rents, no capital coming in to repay and service those debts. So that is causing issues and stresses. And they're managed, we said last week, watch again on our YouTube channel, to defer the debts on those businesses, but those will become due at some point. And how is that going to be managed? And how are China going to manage that politically in a global economy if they want to isolate themselves? What we've seen very clearly is that with China, they had a revolution in the late 40s, and Taiwan is not a completely independent sovereign state, and it's claimed to be part of China territory, but the opposition in the Revolutionary War, it took up control and created their own economy in Thailand. If you're a cynic, you would say that China and Russia did a deal, that after China quickly took over Ukraine and reclaim those lands for Russia, that Russia would then support China to take over Taiwan, making belligerent noises about that, which is now having a bit of a consequence in terms of world trade. And we see that the USA, with their economic and financial power, are now disengaging from China and creating new working environments. So there's a new Vietnam USA trade agreement been signed this week to up the amount of tech and microchip manufacturing that can go on in Vietnam. India is already replacing China as the major source of spare parts for Apple iPhones and computers, which is taking business and trade and wealth and income away from China in the short term, contributing to their recession, which could have a spiraling effect on their economy as they become a maturing economy rather than a tiger economy that's growing rapidly. For the new economies in Asia, which are getting this inward investment in India, in Vietnam, Cambodia, and countries all along Southeast Asia, big opportunity for places to develop and for expats to support that growth and for businesses to engage with those economies. So there's big moves that are being made there, and it'd be interesting to see how that develops if the UK India trade deal comes off, how that can take us forward. China is not the biggest population in the world. That's now technically India, and with the education and the language and the history of India, it's set to become a prominent economy in the next phase of the 21st century in which we're living. So it's a world of constant change. Expats need to look for new opportunities. You see, the Middle East is a growing, dynamic environment where they're looking for economic and tourism investments to replace oil for the future. So the world of change, anticipate that and grow into it. And for more help and guidance on living and working abroad, investing offshore, contact us at approachpartnership.com. The next topic to discuss today for UK expats living and working abroad is that HMRC rules. HMRC have got rules. Every tax authority has rules, and it's about obeying the rules to pay the right and the fair amount of tax. Not too much, but not too little. So expats living and working abroad from the UK can enjoy big tax breaks. So you can pay up to 45% income tax, social insurance taxes, and other taxes in the UK. When you go and live and work abroad, you can pay less tax, but even in the UAE, you might be paying some tax now. These taxes are there, and it's about having one tax residence where you declare your worldwide income under a double taxation treaty, so you're not paying tax in your home country. A British expat living and working abroad, if they're not living in a country with a double taxation treaty with the UK, but full liability back in the UK. Now, if you get a rebate or if you get an assessment from the revenue and it's wrong, spookily enough, that might seem like good news when you put that money in the bank, but it could have consequences for you down the line. And this is the thing to consider. We follow the rules and we make the right tax declaration. If HMRC make a mistake, they could make a mistaken assessment and they could rebate you too much money. If the HMRC makes a rebate to an expat that goes to live and work abroad or registers their pension overseas, so when you've got a pension from the UK, you can register it to pay tax in your country of residence, be that France, Cyprus, Portugal, or elsewhere under the double taxation treaty, potentially pay less tax on your pension in that country than you would in the UK. But if you get a rebate from that process, and the HMRC are wrong in that rebate and they paid you too much, then potentially you've got another liability and penalties to pay on the amount of tax that HMRC rebated to you. Now, recently, in a court tribunal case, somebody appealed against this kind of instance where they've been given a rebate by HMRC, pay as you earn in the UK. So it's entirely HMRC's error in working out they should do a rebate and paying that rebate to an individual. And when they spotted it a few years later, not only did they charge her the tax back, but they charged her penalties and interest on the tax that they'd rebated her, and she understood it was hers in good faith based upon the HMRC advice. And this got all the way, the taxpayer appealed, HMRC rejected the appeal, and it got all the way up to the court tribunal to say these penalties and interest are not fair because the HMRC paid the rebate and didn't ask for the tax. But the court tribunal ruled that actually HMRC rules apply. So when there's interest and penalties to be applied, just for the HMRC to apply them. And the court could not overturn the application of a penalty and interest charge by HMRC, whether it's their mistake or whether it's your mistake. Now, if it's your mistake, you pay the price, you pay the penalty. But if HMRC are making mistakes and you're taking those on board in good faith, they still apply the same rules for penalty and interest. Now, they could, at their discretion, give an exemption, but those of you who have dealt with HMRC in the last couple of years, and that's not that many because you don't really get anything done through the HMRC, a very, very slow administration process, you'll find that you can get caught up in a system, and those penalties and late payment penalties will come back to haunt you. So the best thing to do is to make sure that your tax returns are submitted, they're correct, and they follow the rules, and that the returns are done on time to avoid those penalties and charges. The HMRC rules are theirs to apply, and they can't be overturned. So the best thing to do, if you've got an issue as an expat with HMRC, contact us at productpartnership.com and we'll help you and advise you and guide you on how you can minimize any liabilities and make an appeal to try and get a discretionary reduction in any charges that they're making, but otherwise confirm you're paying the right amount of tax and avoid those penalty and late interest charges. More information, guys, on helping with UK tax registration returns, contact us at productpartnership.com. Just checking my notes. Thank you very much. Thanks a lot for listening today. And the next on our Living and Working Abroad show is looking at pension savings. UK expats living and working abroad aren't necessarily paying national insurance in the UK. One thing that national insurance in the UK does is it contributes towards a UK state pension. Not all countries offer a state pension, and you may not choose deliberately not to have one. But if you're living and working in the UK, any type of job where you're paying national insurance, that will contribute towards a state pension. If you contributed for 35 years, then that gives you the full UK state pension. Now, currently, that's £203, and it's triple locked for a price rise each year. That price rise could, that increase in the state pension could be 2.5%, or it could be equivalent to the September inflation or salary rises, real wage rises, index rises in the UK. So even though you're an expat, If you've got a UK state pension, then that is still indexed by wage inflation in the UK or price inflation or 2.5% as a minimum increase. So what we've got now in the UK is a situation where 8.5% wage inflation over the last year means that potentially the UK state pension can have another jump next April. The current level of £203 a week to £220 a week, which is about 11,500 a year. So the UK state pension is getting close to the position where it's going to be the equivalent of the personal allowance. The personal allowance is fixed at 12,570, and it's fixed at that for the next few years. So it's not going to increase. And so within under the current regime, so if the current fiscal rules are applied by the UK government over the next 4 or 5 years, with wage inflation or indexing of those state pensions, it's going to be equivalent to the personal allowance. So a UK expat can still get the equivalent of the personal allowance, tax-free income from the UK when they retire, if you've got the 35 years contribution. Can an expat provide for UK state pensions? Yes, you can. Is it worth it? Well, think about it. There's two ways of paying for a UK state pension. One is to pay as a sole trader, where you're paying around £350 a week, and the other one is a voluntary contribution, where you're paying about £17.50 a week. So that's the difference between 184 a year and 900 a year, and that gives you each year's contribution gives you £300 extra state pension a year. So if an expat overseas makes a voluntary contribution of £900, they will get, once they get to UK state retirement age, they will get their money back within 3 years. Within 3 years. So 3 years of retirement from age 66. So anybody retiring in the UK state pension is 66 or onwards will potentially get their money back from their voluntary contribution, £900 a year, £17.50 a week, within 3 years. So that could be quite an attractive investment, possibly. It's a fixed investment, it's a cautious investment, but it's still there. If you're a contractor and you're in business, it's a tax deductible expense, or it's paid by an employee. So even if you're working abroad, you could still be maintaining your national insurance contributions. When you're working on a short contract abroad, you could do class 2 contributions. It's only 184. National insurance contributions, well, as an expat, you don't get any other benefits in the UK from that, other than contributing towards the state pension. But that alone is worth it in itself. Now, can the UK government in the long term continue to afford that? Who knows? And will it get capped at some point as an amount of total revenue, increase the state pension age, cap the thing? They could easily say, well, the state pension will be the equivalent to the personal allowance, and that's the way they could manage it going forward and end the triple lock system. So there's lots of different things that could happen. However, for an expat living working abroad, if you're working abroad for 4 or 5 years, it's still worth you contributing into that UK system, because if you're relocating abroad when you're 30, you could already have up to 14 years contributions into the UK. So it brings you that extra pension. And don't forget, expats, that there's this big change in state pensions under the Gordon Brown era. And so if you are short, you didn't contribute between 2006 and 16, you can add those extra 10 years in as a lump sum. You have to do it as a voluntary contribution. That's £900 a year equivalent. But that each year, like I say, would increase you annual pension by £300 a year. So that would give you an extra £3,000 pension a year if you made those extra contributions. So it could be deemed to be worthwhile for someone who hasn't any other form of income. And if you're in the UK, it could be just your UK taxable income. So it's well worth considering pension savings, making the best of your contribution level to pay as you go, where you're living and working abroad on a short-term contract or longer term, and to catch up. And for more information and guidance on that, contact us at proactpartnership.com. We're on Twitter Space. You can chat to us there and listen there, and you can listen again at Twitter Space. Go to ProAct Says, or you can watch back our YouTube channel for Living Working Abroad show. Our next topic, I'd like to talk about bankers. What do you think of bankers? You'd think they're there to provide a service, but under modern day rules and international tax rules, with common reporting standards, exchange of information initiated from the OECD back in 2014, there's a progressive tightening of constraints to make sure that there's no terrorism, there's no money laundering from criminals or despot political leaders around the world. But these rules that they apply for the really evil things that go on in this world affect most of all the ordinary working person around the world. And for expats, the particular challenge now is with banks. They need a license, and because the rules have changed, there's a lot of compliance and extra compliance for a bank to have to provide services for somebody that's cross-border. Then banks are pulling back and reorganizing themselves. So it may be the HSBC Bank, but it's not the same as it was before. HSBC have to have individual banks with individual licenses to cover individual needs. Some banks can offer a wider international service, but they have to go to a higher level of scrutiny and checking. And this can lead to anybody who's called a politician being interpreted as somebody that they can't offer a bank account to. Or it could be you could have a situation where you're working abroad, but they don't know where your money is coming from, so they can't take your money from you, or they can't understand your address because your utility bills in a foreign language. All Greek to me. Anyway, so the common reporting standards started out as exchange of information, and those rules are applied and restricting people, and you now have to update with your bank every couple of years to show that you're alive and where you're living and where you are a tax resident. So they've got your tax number, they've got your address and the name, and they then exchange that with all the countries where you are have got an interest. So you've got an investment in America, in American shares, and you're a tax resident in the UK, they're exchanging that information into the UK. But if you're an expat that's living in the UAE and not paying any tax there, but you've got a property back in the UK, they're exchanging information back into the UK. You're a UK citizen, they exchange information back into the UK. Because don't forget, you're domiciled to the tax country in which you're a citizen. Unless you change your domicile, that is your default tax environment. So the UK, for UK expats, has always got a right to tax you unless you're in another country as a tax resident under a double taxation agreement. So you've got your shares in America, British citizen, exchange information into the UK. You're working in the UAE, they exchange information back into the UK. And America and the UK and UAE can all see that information. It's all shared because there's a common reporting standard of that information around all the different companies. But now, when you have a company with shareholders, or if you create a family trust or a business trust, you also have to validate the transactions within that arrangement. So when you're moving your money as an individual, if you want to move money 50,000 into the UK to buy a property or make an investment, you have to prove your source of funds, which is one thing. So when you get to the next level up and you're scaling up, and you've got a business or a family trust or family business that's moving money around, you have to have a transaction record for those movements. If you put a property into trust, you have to record that on a register with the regulators in the country where that transaction is happening. And same with financial investments, property, and banking movements. So all these transactions will need to be registered, and that registration makes them traceable at some point if the taxman's rules, they felt they were ever broken and wanted to do an investigation. This is why it's important that we internationally follow the rules and make the right applications in the right place. Coming in is increased scrutiny on transfer pricing, so that if there's common ownership between companies, they tighten up on the transfer pricing rules, which means that you may not be able to get away with across a holding company taxing the money out, invoicing the money out of another company into a lower tax jurisdiction. So there's restrictions on that as well, plus the sort of minimum corporation tax rate standard, which has been set at 15% for the world, gradually being introduced, which is why we're seeing some countries which previously weren't charging expat taxes now introducing some. So it's a world of change, led by the bankers, but the bankers, to be fair, are led by the regulators on international tax and the OECD. So for more information and guidance, and to certify and maintain the integrity of your overseas property investment and trusts, contact us at projektpartnership.com. Our final topic for today is to discuss that death is hard on a family. Put aside the fact that somebody's dead and you've lost a loved one, we know that's hard. But death is also hard for many other reasons. We just discussed there in our last topic on bankers, how the common reporting standards require certification of everything that moves. So everything is recorded now. And it's the same on an estate. So if somebody dies and they own property, they own vehicles, they own shares and business and investments, each of those has to be verified. Now, the way that that's done is you have to have a court-appointed administrator of the estate that makes sure all the debts and all the taxes of the deceased are paid appropriately before the assets are then distributed to the family. Now, in the UK, that could mean a 40% inheritance tax. And, with the UK collecting an ever-increasing billions of pounds every month in inheritance tax from estates. And in the UK, inheritance tax has to be settled within 6 months of death. So that might mean that either the beneficiaries have to fork up the cash, or they have to force sell the property or the business, or take a loan to pay the inheritance taxes technically due within 6 months of death. Given that it takes an average of 9 months to settle a probate in the UK, that's quite good timing for a HMRC rule. The the complications though can go beyond that. So when you cross border, different rules can be applied. So within the EU, for example, you can do a settlement of an estate, but you have to do your worldwide settlement from the country in which you die. So if you're French living in Cyprus, you still have to settle your estate in Cyprus. Now, you might still be bound by Cyprus rules of dying, about who can benefit and who can pay taxes, but that doesn't mean that you're free of your French or your Spanish or British obligations as a citizen of that country as well. So you've got different legal jurisdictions with different requirements when people die about how wills are written and who can benefit. So in some countries, you've got forced heirship where the estate must go to children in proportion. Other countries, it can be allocated by wills, but some people can be excluded and some people can't be. Some people can benefit only to a degree. In England, you have trust law under English law, which is applied in other countries, largely Commonwealth countries, but you can't use trust law in somewhere like France. So these are the issues that come up for people on a regular basis. Most importantly, if you've got a fixed asset in one country, you can't settle it from an estate in another country. So if you're living and working in Cyprus and you die, as a European country, you have to settle your worldwide estate under Cyprus law. But then, once you've got that, if you've got a fixed asset of American shares or UK property or Isle of Man investment or Irish pension, you then have to have a separate administration for each of those jurisdictions to settle that estate. Now, that could be an administrative thing. It could be a resealing of the existing administration authority, but it's still a legal process. It's still a court process. It still potentially involves having to have people in that location. So if it can't be done administratively by post, that somebody has to turn up, then potentially you've got legal and agent fees in each country in which you've got assets. And when you're doing that, you have to have registered, legalized people to do that work in each country. And in which case, because the family is not represented, because the family is living abroad, it's going to increase the cost of the estate and the probate administration and the time exponentially. Because to settle one estate, to get the grant of probate is going to take 3 to 6 months anyway, and more likely 9 to 12. Okay, that's the first instance. You then have to reseal it in each country before you can free the assets, pay the debts, and distribute the estate to the children. What's ProAct view of that? Well, we say protect the family down the generations. And English law allows for trusts, which can be used in USA, the Commonwealth, Ireland, UK, Cyprus, and other countries around the world. They can be based there, even if the assets are maybe somewhere else, and they could be the legal owner, the tax owner of the shares, of the property, of the investments. And if the trust owns the investments, and if the trust owns the property, and if the trust owns the business shares, then in the event of death, there's no probate administration required to transfer those assets to a beneficiary. Save your probate costs, no time, no hassle, no bother. You do have to pay to set up and run the trust now. So it's like running a family business through the trust without the taxes if you're using a Cyprus International Trust for your family gifts. What is more, if you've got an inheritance tax liability on your estate, potentially by gifting the assets into a family trust, you can avoid that inheritance tax. So if you put £1 million property from the UK into a family trust, it's potentially exempt from inheritance tax in 7 years. There's no probate, so there's no reporting anyway. We have to follow the rules, common reporting standards, everything's exchange information, the transactions are each recorded, everything goes by the book. We follow the HMRC rules, we follow the rules of all the countries, but it's still a way for you to pay now to administer your affairs and have your arrangements in place to avoid the complication of dealing with your estate when you die. And that is why at ProAct, we recognize that death in the family is difficult. So manage it today. Don't leave your widow, don't leave your children in another country with a problem to deal with because you didn't organize your affairs properly while you're alive, using your money, financial resources, instead of paying tax and legal fees to do that administration over 2 or 3 years after you die. Let your family celebrate your life and mourn your death and not bitterly regret the amount of hassle and grief they're put to because of the constraints of bankers, of regulators, and the legal systems around the world. For more information and guidance on family trusts and protecting the family against the cost and delay of probate and inheritance taxes, contact us at proactpartnership.com. I have to put my glasses on to see if I've got any questions that have come up today. So I've got no live questions at the moment. So thanks a lot for that for today. Next time on the Living and Working Abroad show, we'll be covering some other topical subjects as we go into the autumn to look at what an expat can do to protect their family and business living and working abroad. Contact us at our website, proactpartnership.com. You can watch this again on YouTube, watch for our short versions of the little bits of information or on the Twitter space. And don't forget to share with your family and friends and spread the word so we can help more people, expats around the world. Thanks a lot for listening. We'll see you next time.